Good evening, and welcome to the Crypto Overnighter. I'm Nikodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's 10 p.m. Pacific Time, Sunday, April 30th, 2023. An executive of JP Morgan Asset Management warns the possible collapse of First Republic Bank could have a domino effect on other regional banks in the United States. Bob Michel is the Chief Investment Officer of JP Morgan Asset Management. He said in an interview that First Republic's liquidity issues could affect the entire banking industry. He said, quote, "I think we have both. I think it's somewhat naive to say that this is just limited to First Republic." He said the liquidity issues faced by First Republic should never have happened. He said it shouldn't have happened because banking is, quote, "the most heavily regulated capitalized industry on the planet." Now, he believes that there needs to be more continuous progress to some sort of resolution. That is, if the impact of First Republic's downfall is to be contained. He said the high price of everything is a significant factor leading to the recent banking crisis. He said the bottom quartile of earners in the United States have had it the worst, and that they've had to blow through their capital reserves just to stay afloat. He said most people's deposit balances are now even lower than before the beginning of the pandemic. Michel believes that a solution needs to happen soon because regional banks are heavily dependent on the FDIC and federal home loan banks. Quote, "I think the regional banks are heavily dependent on the FDIC. They're heavily dependent on the home loan bank to get additional cash. We don't know how they're going to operate when those two programs expire." During the last quarter of 2022, both Signature Bank and Silvergate Bank reportedly received substantial loans from the FHLB. Those loans totaled nearly $10 billion and $3.6 billion respectively. Despite the financial assistance, both banks eventually collapsed due to significant deposit outflows. Ryan Selkis is the CEO of blockchain research firm Messari, and he suggested in a tweet, unless government recognizes that Federal Reserve policies are to blame and not crypto, well, then more banks may face failure in the future. This comes after those in the know told Bloomberg that the U.S. Department of Treasury staff members are reportedly studying ways to expand the current deposit insurance beyond the maximum cap of $250,000 to cover all deposits in the United States. According to the FDIC, domestic U.S. bank deposits totaled $17.7 trillion as of December 31st, 2022. The collapse of First Republic Bank would also hurt the cryptocurrency market. I say that because First Republic Bank is a significant player. Its failure could lead to a loss of confidence in the crypto sector. In addition, First Republic Bank provides banking services to many cryptocurrency companies. So its failure would disrupt the operations of those companies. All in all, the collapse of First Republic would lead to a decline in the price of cryptocurrency. Now, it's clear that the government, or at least part of it, has gone to war against crypto, claiming it's bad for the economy when bank failures are what's killing our economy in the US, not crypto. Crypto's in danger of the banks, not the other way around. I mean, just look at the examples of SVB, Signature Bank, and Silvergate Bank. These banks all collapsed due to significant deposit outflows, despite receiving substantial loans from the FHLB. It's clear that the banking system is in crisis and that crypto is not the problem. In fact, crypto could be the solution. Cryptocurrency is a decentralized, secure, transparent way to store and transfer value. It's not subject to government or bank control, and it can be used to make payments anywhere in the world, instantly, and for a fraction of the cost of traditional banking fees. All of which means that the government should be embracing crypto, not trying to kill it. Crypto has the potential to revolutionize the financial system and make it more fair and accessible for everyone. The government needs to wake up and realize that the real danger to the US economy is not crypto, but the banking system. They need to stop trying to kill crypto and start working with it to build a better future. So it should be as no surprise that a new survey shows 46% of millennials own crypto. A new survey by BitGet found 46% of millennials across major population countries own cryptocurrencies. They studied 255,000 adults from 26 countries. It also found that Gen Z and Gen X were more likely to own crypto than baby boomers. The survey results suggest younger generations are more open to investing in cryptocurrencies than older generations. This could be due to a number of factors, including the fact that younger generations are more likely to be familiar with the technology and the internet. Also, the younger folks are more likely to be looking for alternative investment options. So if you're a boomer and you love crypto, you're kind of a unicorn and everybody loves you for it. This survey also found that millennials are more likely to consider cryptocurrency regulation when voting for political candidates. This suggests that millennials are taking cryptocurrency seriously. They're looking for leaders who will support the development of this new asset class. The rise of cryptocurrency ownership among millennials is a significant development. It shows younger generations are embracing this new tech. They see it as a viable investment option. This will have a significant impact on the future of cryptocurrency, as it naturally leads to increased adoption and demand. And that might be because they see a direct link between the debt ceiling and the price of Bitcoin. The United States House of Representatives passed a bill to increase the U.S. debt ceiling on April 26th. This leads people to think about its potential impact on the price of Bitcoin. Unsurprisingly, those answers range from highly bearish to overly bullish. And ultimately, US dollar liquidity is the key to both opposing viewpoints. So, would a deflationary recession produce a 2020-like Bitcoin rally? There's every possibility that raising the debt ceiling could prompt the Federal Reserve to print more money, thus boosting capital inflows to risky areas like Bitcoin. That's the view of some analysts, including Jesse Myers. Myers is the chief operating officer of investment firm OnRamp. The debt ceiling represents the maximum amount of money the U.S. government can borrow to pay its bills. Raising it means that it can issue more debt to generate more capital. The issue with that is, since the Fed isn't buying bonds, thanks to its quantitative tightening combined with the flow of available money crashing, that means the U.S. government might have a hard time finding people to buy its debt. In other words, a deflationary recession is coming. Now, people like Myers believes that it will force the Fed to return to a quantitative easing policy. Quote, when the debt ceiling is lifted and credit contraction leads to economic crisis, they will have to print money on a massive scale. And everybody who's listening to the show knows Bitcoin made out like a bandit during the last round of stimulus. The view of some is that a blow to the dollar's credibility would boost Bitcoin's price. The government has already hit its $31.4 trillion debt ceiling in January of 2023. Theoretically, that means it cannot generate any more capital until the U.S. Senate passes the bill to raise the ceiling. Theoretically. Watchers of U.S. politics knows that it is unlikely to pass the Senate. And even if it did, President Biden has vowed to veto the bill. This standoff could result in the U.S. government defaulting on its debt in June. Doing so means negative consequences for the US dollar. That's according to Jeff John Roberts. He's the crypto editor at Fortune. Quote, if Republicans decide to go the kamikaze route during the current debt ceiling standoff, it will deliver another major hit to the dollar's credibility and a further boost to Bitcoin. Former U.S. Treasury Secretary Lawrence Summers downplayed the fears of a potential debt default, saying the odds of it happening stand under 2%. Quote, I think the odds that we will default in the sense of insolvency and over some interval people who hold bonds who will not be able to get paid are, assuming the balance of a major war, certainly under 2% over the next decade. Presenting a similar outlook, analyst Ted Talks Macro says extending the debt ceiling would ensure that the Fed continues contracting its balance sheet by continuing to close off the tap to all that easy fiat money, which points to lower liquidity. That in turn means more downside pressure for Bitcoin. Quote, one caveat to the liquidity downturn sideways for the rest of 2023 would be the Fed winding up or slowing the pace QT. This impact of the debt ceiling on the price of Bitcoin is uncertain. Some analysts believe that it could lead to a rally. Others are calling for a sell-off. Ultimately, the market will decide. And that brings us to our cover story for tonight. Google Cloud and Polygon announced a multi-year partnership to boost the development of Ethereum scaling protocols, tools, and infrastructure. The partnership will provide Polygon with Google Cloud's framework and developer tools. This will help simplify developer integration, which makes it easier to build, launch, and grow Web3 products and decentralized applications on Polygon. Google Cloud's partnership with Polygon is expected to advance Polygon's zero-knowledge development. Testing of Polygon's ZK EVM's zero-knowledge proofs on Google Cloud reportedly means faster and cheaper transactions compared to the existing infrastructure available. The Polygon ZK EVM beta is an Ethereum virtual machine scaling solution. It was launched to mainnet in March of 2023, powering reduced transaction costs and increased throughput of smart contract deployments. Google Cloud's blockchain node engine will be used by the Polygon ecosystem. It will assist with time-intensive processes and costly overheads of acquiring, maintaining, and operating dedicated blockchain nodes. This specific integration works toward removing the need for Polygon developers to configure and run Polygon nodes. The partnership provides capital resources to the Polygon ecosystem developers and companies that are building Web3 products and apps. Certain early-stage Polygon Ventures-backed startups will get certain benefits. They will be able to receive newly launched Web3 specific bonuses from the Google for Startups Cloud program. The initiative includes collaboration with a whole host of Web3 firms, including Alchemy, Nansen, and Solana. Google Cloud announced its plans to assist Web3 startups and projects to build and scale faster and more securely. This new offering expands on the existing initiative called Google for Startups Cloud program. It includes additional Web3 specific benefits. According to the official press release, eligible Web3 technology projects and startups from pre-seed to Series A can apply for the Google for Startups Cloud program. Projects can also opt in to Google Cloud's Web3 specific benefits. These benefits include up to $200,000 over 2 years in Google Cloud credits and technical and collaboration support. Quote, "Our goal is to enable Web3 builders to focus on what really matters: speed to market and innovation. This means giving startups the ability to build on our managed, serverless platform at no cost, as well as the resources and community to be successful. Furthermore, access to grants from Aptos, CELO, Flow, the HBAR Foundation, NEAR, and the Solana Foundation will also be available. Each of the founding partners will be offering exclusive grants of up to $1 million. That's funding to help accelerate Web3 startup growth and resources to support development. The program will offer access of up to $3 million in investments from the Polygon Ventures Ecosystem Fund, priority review from the Ventures team, and all the other Polygon Venture benefits. Some other perks by Google Cloud include priority review for the base ecosystem fund and access to testnet, as well as a discount on Nansen products and engagement fees, credits for Alchemy, and priority access to Alchemy University. Google Cloud has been fooling around with Web3 since 2018. That's when it added data sets for Bitcoin. Since then, they have forged partnerships with several industry leaders, including Coinbase. It partnered with BNB Chain last year to offer Web3 startup infrastructure. The cryptocurrency market is expected to react positively to the news of the Google Cloud and Polygon partnership, because Google Cloud is one of the world's leading cloud computing providers, and its partnership with Polygon is a major vote of confidence in the Ethereum scaling protocol and cryptocurrency as a whole. And that's going to do it for us tonight. I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, then please like, follow, subscribe, leave a rating or a review. And in the meantime, we'll see you tomorrow night.